Hi guys, welcome back to the channel. I want to share something to do with discretionary trading, and there's a lot of stuff banning around about discretion, and traders are getting kind of confused and thinking that you can actually just become a good trader just by thinking you know what the market's going to do, and that's not true. Although discretion plays a huge part in becoming an all-rounded, well-rounded trader, and will make you a better trader, no doubt, it's not something you can use to just trade the markets continuously and expect a consistent profit. But what I will show you is how the power of building discretion can help you become a better trader by reading the tape, by reading the price and putting in the reps into the market, and how you can use that to keep yourself from taking only high probability setups. Now, the first thing I'll say about discretion is you have to earn discretion. It's not something you can learn. I can teach you all that. I can say it's a bit like saying, to your kids when they're running around, if you run around fast, you'll bang your head and you'll hurt yourself. They don't want to believe that. They have to learn that for themselves, and they have to earn that through experience. You can tell people a lot of things, but you don't really believe it until you see it time and time again in the markets. That's how discretion works. And then when you can apply that and add it to your technical analysis, and it lines up with your technical analysis and supports your thesis and your theories and your predictions, that's when it gives you added power, and it will keep you out of certain situations, and it will put you into certain situations, and it will also dictate your level of aggression when you're taking certain trades. So what I want to share with you here is just a couple of things on discretion on a couple of pairs that are very correlated. So the first one is the Aussie dollar, and the second one is the New Zealand dollar. Now, to the uninitiated trader, these look like very, very similar markets. If you just flick between the two, they look very similar. The way they're moving, the way that the shape of the market right now is very, very similar. However, the Aussie dollar is a pair that I wouldn't look to short right now, and the New Zealand dollar is a pair that I may look to short right now. And I favor shorting the New Zealand dollar over the Aussie dollar, and I'm going to explain a couple of differences why. So first of all, let's look at the Aussie dollar. If we go out to the daily time frame, which is my higher time frame, and bring out a horizontal line, the first thing I can see is where we've just recently found this support level is also a major level of structure looking left. We've had this resistance hold. We then had a support level tested here, here, and here, and we've held that level. That's clue one as to me going, well, I want to hold my horses a little bit here. I don't want to short this until I can see extra confirmation that we're going to break and close below that low. The second clue is reading the price a little bit closer and seeing this, right? So we had this big bearish momentum candle. This is what we call a fake break. Fake break to the downside. We had this big bearish momentum candle. If you can see here, the market actually opened the next day higher than the close of the previous day. And then within a very short period of time, literally 24 hours, we're back up to where we were trading initially. Whenever we see that, that is an indication that we're likely to see a little rally, a little relief rally. The bulls will take control for a bit. We see a lot of buy orders kicking around here, and we see that relief rally. And it usually means that there's probably going to be a pause in a continuation to the downside. And that is just by reading structure and the shape of these candles, the way the market participants' reaction displayed through a daily candle reaction. Now that's the Aussie dollar. When we go to the New Zealand dollar, looks the same, okay? It looks the same. However, when we scroll out and look for previous structure looking left, yes, there's some choppy inside resistance here, okay? But the next level of support looking left is down here. So we've got some room for potential movement as opposed to the Aussie dollar, where we're right hitting up against that support level. So one, that makes it more attractive to me. Two, we don't have that fake break. We did break down like we did on the Aussie dollar, but we didn't push all the way back up immediately to where we left off. That is an indication that we're likely to continue down. And now I can start looking at a more attractive short here, because we had this support level become resistance. We held this level, broke through that. Now I can start to look down on the trading time frame and drilling down into how I could potentially short this market. Whereas the Aussie dollar, I wouldn't even give that a thought. I wouldn't be looking to short this right now. So I want you to get that this may just go short, this Aussie dollar, but for me and the way that I put, the way that I analyze markets and the discretion that I've built up over a long period of time of looking through each market 3 times a day for years and years and years and years and years, that gives me almost like I can see a breathing pattern in the market. I would never place a trade just off of that, but I would avoid taking trades when I can apply my discretion to my technical analysis, and that's why, because I want to stay out of the kind of diluted, low probability setups to the real strong, pungent, high probability trades, and that's how you do it. So that's just a little idea for you guys. I hope that gives you value. If you got value from it, let me know in the comments. Let me know how you use discretion in the comments as well. And don't forget to give the video a like and subscribe to the channel for more like this. And I'll see you next time. Good luck in the markets.